So you've had a session with Sunday on one of the questions for the diet we have selected. So let's do another one. This time looking into the 50-mark question. So we will pretty much apply some of the things we've learned today, particularly regarding risk and audit procedures. So the first thing is to read the question. The first thing is to read the question. And I'm trying to see if I have that opened up here. I think a better approach would be to give you time to read the question on your own. All right, so remember we're looking at the question called RIC group. RIC group, that's the first question on the one I dropped. So I'll just go through the first page and then the second page, and then you can take it on from there. It's 1st July 2005, and you are the manager responsible for the audit of Atlanta and Co. Sorry, you are the manager in the audit department of Atlanta and Co, a firm of chartered certified accountants. You are working on the financial year ending 30th September 2005. All right. Sorry, I think I need to do that. Let me just, because I remember that I have a couple of things that I wanted to show you in terms of reading questions, how to go about it. Okay, so I'll just project right now. Let me know when you can see my screen. I think it's this one, yeah.
Yes, we can see your screen.
Yes, you can see your screen.
Yeah. So as I said, opening paragraphs, very important. You've got to be able to pick some relevant information from it. So if we use that now, we can see here that this is now, okay, but then this is the year end, 30th September 2005. So that obviously means we are still far from the year end. We are told that it's a group and it's a listed entity that offers internet television network to over 10 million subscribers in 8 countries. So that's a lot of information regarding the nature of the entity, right? Yeah, so the fact that this data already indicates this vis-a-vis this, it potentially tells us already that we're at the planning phase, right? You are provided with the following information: an exhibit which you have received from the engagement partner, background information of matters relevant to the audit planning, selected financial information, group management account, an extract of the audit strategy prepared by Negan Associates, the component auditor which audits subsidiary. So obviously you are dealing with component auditors here. Details of the planned acquisition of a new subsidiary and possible joint audit arrangements. Okay, so we move to the next page. We know what the professional marks are for. So, hello, I have provided you with some information in the form of a number of exhibits which you should use to help you with the planning of the audit of risk group for the year ended this. So clearly, still as part of this opening paragraphs, we have here for planning purposes. I require you to prepare a briefing note for my use in which you do what? Using the information in all the exhibits. I don't leave out any. All the exhibits. So if, for example, this is a computer-based exam, all these exhibits will be available to you on the left side, of your screen. So you can click on each one that you need at any point in time. All right. So yeah. So and it says audit risk. So we know what that is about. Evaluate the extract from the components audit strategy, commenting on the audit strategy responses and ethical matters relating to the issues identified. So that's 10 marks. Okay. Principal audit procedures, you will instruct the component auditor to perform on the sale of the property to the group chief executive officer, 6 marks. Using sorry, just take something out here. All right, using the exhibits. Yeah, using the exhibit, exhibit 5, discuss whether it is appropriate for a joint audit to be performed on Michan or Micon or whatever the name is. I'll just call it Mike. Commenting on the advantages and disadvantages of a joint audit arrangement. Okay, another 6 marks. So let's get to the storyline. First exhibit or second exhibit, background information. So typically, I've read this in the requirements. The requirement says audit risk. The requirement says I should evaluate the audit strategy document. The requirement says I should carry out audit procedures on something. Not only evaluate the audit strategy document, but I think they also indicated that there may be ethical matters regarding the audit strategy. Okay, so not only should we comment on the audit strategy responses, but also the ethical matters. Then something on joint audit. So clearly the things they want me to do are known and specific and clear, right? So how do I do that? Exhibit 2, background information. The group started to offer an internet streaming service for films, TV programs 10 years ago. The group's business model is to acquire licenses for films and TV programs, and customers pay a monthly subscription fee to access them and watch online, DSTV. The group has a subsidiary in each country in which it offers its subscription service. So the group has a subsidiary in each country in which it offers a subscription service. Atlanta & Co. audit all of the subsidiaries with the exception of Daryl Co., one of the group's foreign subsidiaries, which is audited by a local firm called Nigan. All companies within the group have the same financial year end, with the exception of Daryl, which reports under local accounting standard. The group companies all use IFRS as their financial reporting framework. So this guy here uses its own local standard, and then one of the group's foreign subsidiaries, which is audited by a local firm. Okay, so we are told that each country, so they've got stuffs in each country. Matters relevant to audit planning. Following a discussion between the group audit engagement partner and a representative of the group audit committee, Several matters were noted as being relevant to the audit planning. 1, annual incentive scheme. For several years, the group has operated an annual incentive scheme for staff, under the terms of which employees are eligible to receive an annual incentive payment linked to the achievement of selected targets. The scheme operates across all group companies, with some employee target linked to profitability, while others are aligned to non-financial measures, including customer satisfaction. Participants in the scheme are entitled to earn a maximum annual incentive of 5% of their salary. Approximately 6,590 employees, including senior executive directors, are entitled to participate in the annual incentive scheme. Last year, the average bonus payment was 1,250 per participant. So, meaning if we multiply, we may be able to get an approximate figure. And then we are also told that for some, it is linked to profit. And for others, it is linked to customer satisfaction. Legal cases. In January 2005, a legal case was initiated against the group by Glencoe, a film production company. Glen claims that the group has infringed copyrights by streaming a film in specific countries for which a license has not been acquired. The group insists that the film is covered by a general license, which was acquired several years ago. The group finance director is not willing to recognize the legal claim within the financial statement, as he is confident that the claim against the group will not be successful, and it does not want to discuss it further with the audit team, emphasizing that there's no relevant documentation available for evaluation of this at this time. Okay, so here is pretty much a legal case, and they are talking about infringing copyright claims. So the group finance director is not willing to recognize the legal claim within the financial statements. Okay, and then they said do not want to discuss further with the audit team. No documentation. Okay, all right, so I keep reading. Remember, the way I'm highlighting, you can also highlight in the exams. Daryl Cole. Negan Associates provide the audit services to Daryl Cole, one of the group's foreign subsidiaries. Daryl is one of the group's larger subsidiaries. It is a listed company in its own jurisdiction with total assets of $140 million. Daryl is the only subsidiary which does not follow IFRS standard, and in its local jurisdictions, company must follow local accounting standards. It uses the same currency as the rest of the group. It uses the same currency as the rest of the group. Daryl Co. was acquired several years ago. A goodwill of $38 million is recognized in the group's financial statement in respect of the company. All right, so what are my key points? Yes. 140 million is what it contributes to the group's total assets. Yeah, so we were already told that it does not follow IFRS. I don't know. I think they repeated that for a reason. And then it's got goodwill. Yeah, then also it is a listed company in its own jurisdiction. All right, let's see what's next. So next exhibit tells us about selected financial information. Group revenue. Again, I always check what I'm given. It's very important. This projected to the year end since we are still in July. So they've projected for the remaining period, August, September. Well, this is actual prior year, right? Group revenue, it's given to us. So always check my numbers. Okay, so this tells me that group revenue grew. If I'm in the exam, I'll just calculate the percentage and put it beside it. Operating profit also grew, so I'll calculate the percentage, put it beside it. PBT also grew, okay, I calculate it, put the percentage beside it. Total assets, yes, we note that, and that's for the group. Included within total assets include license of this amount, which increased, okay, and then goodwill, which remained unchanged. So unchanged, okay, right. Yeah, number of subscription customers actually increased by over 2 million, and that's huge. That is huge. Okay. Notes. The group's main source of revenue is from monthly membership fees. Members are billed in advance of the start of their monthly membership, and revenue is recognized when the bill is sent to the customer, all of whom pay by credit card. The price of the regular subscription has remained 8.2 per month through 2004-2005. Occasionally, the group offers free trial period to new customers. This year, the group also introduced a new premium subscription package, which allows customers to add 2 family members to their subscription for an additional fee of $5 per month. Okay, so what is this telling us? A couple of things actually. Main source of revenue is monthly members subscription or membership fee. Members are billed in advance, okay, billed in advance, and then all of whom pay by credit card. The price of regular subscription has remained this per month. So this is per month, per month, per month. Occasionally, the group offers free, yeah, so free trial periods, and then introduce subscription package, which allows customers to add this. So this is new, okay? The group acquires content licenses per title in order to stream film and TV content to the subscribers. The content licenses are each for a fixed period, fixed time period, varying between 3 to 5 years. The group capitalizes the cost per title as an intangible asset. Group policy is to amortize licenses over a 5-year period. The finance director justifies this as being the most prudent accounting treatment, okay? Goodwill arising on business combination is tested annually for impairment in accordance with IAS 36. This strong performance group, no impairment has been recognized in recent years. Okay, so no impairment, yeah, good enough. They test every year, and then license over 5 years. All right, let's push to the next, probably the last exhibit. Yes, so extracts from component auditor strategy document. The 3 points below are an extract from the audit strategy prepared by Nigan in relation to their audit of Dariel. Other sections of the audit strategy, including the audit risk assessment, have been reviewed by the group audit team and considered satisfactory. You do not need to consider them. Number 1, materiality. Issues identified by Nigan, audit strategy response by Nigan. Materiality. Internet services in the country has been subject to subscription to considerable disruption. As a result of this, a number of customers have cancelled their subscription, and the company is projected to make a loss this year. Materiality will be based on total asset for the first time this year due to the significant reduction in revenue and profit. Based on 1% of total assets, materiality is considered at 1.4%. In the previous year, materiality based on revenue was determined to be $1.2 million. You have no idea why I'm laughing. Or maybe you may. I think you should. Anyway. Why am I laughing? I think I should say it. So, this is, okay, number one, this is the first time I'm seeing this question, right? And the thing they are raising in this strategy document is related to those things that I was saying about materiality when we were doing our review, that they can ask practical questions around materiality. I never even knew they already asked last year. What they are talking about here is the fact that this year we've decided to change our benchmark for materiality. Last year it was based on revenue, but because of this event that is happening, they've decided to change it. The examiner is saying you should respond to these responses. What are your views? Very practical issue on materiality. Anyway, let's move on. Payroll. From 1st October 2004, that I believe is the beginning of the accounting year. Yes. Payroll accounting services are provided to Daryl by Negan Associates as an additional non-audit services. Planned audit procedure. I agree the total payroll figure estimated to be 6 million from statement of profit or loss to the payroll report generated by Negan as no further audit procedures are considered necessary. Sale of property. Daryl Co. sold a small unused building located on the coast to the group's CEO in February 2005 for $50,000. The amount is still outstanding for payment. The group CEO is planning to use the property as a holiday home. Confirm 50,000 is included in receivables within current asset. No further audit procedures are considered necessary because the transaction is not material to the financial statement and local accounting rules do not require disclosure of the transaction. Interesting. Okay. Final exhibit. Potential new subsidiary. Sorry, just one moment. There is sold a small unused building located in February 2005. So that's during the year for 50,000. The amount is still outstanding for payment. Okay. Okay. Next, Exhibit 5. The group is planning the acquisition of a new foreign subsidiary, Mike, which is located in Farland. The negotiations are at an advanced stage, and it is likely that the acquisition will take place in October 2005. You remember I told you always track dates that you see within a scenario. The group's audit committee has suggested that if the acquisition goes ahead, due to the distant location of the company and the fact that Atlanta Co. has no offices in Farland, a joint audit could be performed with current auditors, which is Lucille Associates, a small local firm of chartered certified accountants. All right. I don't even know if I've been talking to myself. Are you people still with me? Are my people with me?
Yes.
Yes.
Okay, good. Now, as you know, it is time to pass the buck to you. So, I finished reading the question. Me, I understand the requirement and I've seen the things I think I need to see in the scenario. if you are a candidate and you are the examiner, and as we have agreed in this class, the first thing you need to do is to determine the structure. Plan your answer. Say plan your answer where you are. Exactly. Good. Plan your answer. So you've got to plan your answer, and then you will now start identifying your discussion points. Then you will now start writing, and you have 1 hour, 30 minutes to put everything down if you are in the exam hall, or a little bit more than that, depending on how you used your 15 minutes reading and planning time. But don't jump into, goodwill is there. They said something about goodwill. That's number 1. Boom, boom, boom. You started writing goodwill. Plan your answer. Okay? So as usual, please, if you are joining us for the first time during this revision, please feel very free to contribute. In fact, you see those guys that are in the normal class, they know everything already. In fact, I was struggling to find a question that I'll come and solve with them. They know everything already. So please feel free to contribute, and all you need to do is raise your hand, and anybody who raises his or her hand will be recognized. All right, let me project my writing material. Sorry, just a moment. What's happening here? Okay, good. No, not you. Not you. Sorry. Okay. So let me know when you can see my screen.
Yes, we can see.
Yes, we can see.
Brilliant. All right, good. So as usual, the first thing we do once we finish reading a 50-mark question is to ask ourselves, how would you approach the question? What's your answer plan? So I am listening. I'm listening. I am also waiting for anybody who wants to share how you plan your answer. And if you have to think through it first, no problem. But once you're ready, just indicate. Arit, you are ready already. Okay, go ahead, go for it.
Sorry, Shay, it's not the answer. You talked about the structure, right?
Yeah, I'm talking about, yes, how you plan your answer. So the structure, okay. Yeah, your mark allocation, you know that stuff, right? Good.
Yeah. Okay, so I'll give 6 risks. I should be able to find 6 risks. I'll give 5 materiality. I can only see 4 trend analysis. So I'll be giving 4 trend analysis. That should give me a total of 25 marks, all things being equal.
Wait. Let me see the magic you performed to get there. So 4 trend, 6 risk. So how many marks do you expect for your risk?
3 marks.
Okay, so 6 times 3, you believe that gives you 18 marks. What else? 5 materiality, so you believe that will give you 5 marks. Trend, you believe that will give you what?
2 marks.
2 marks. Okay, so this is how you got your 25. Okay. Another person. Well, you are not done. 50 marks is what I wanted to plan for. What else?
Okay. For the audits, okay, for the second question, I should think 5 audits strategy and 5 ethical matters. the other procedure, that's the B2.
Pretty much that would be 1 mark each. That's what you believe you get for that. So you give 10 points, huh?
5 each, yes.
Okay, what else?
Then in B2, I believe it's one mark per audit procedure. So that's six procedures.
Okay, so 6 procedures, okay.
And then for the advantage and disadvantage of joint audits, I believe it's 1 mark each, 3.
Okay, so you believe that's also 1 mark each. So 3 merits, 3 demerits. Okay, I see your plan. If you have a differing opinion, could you please indicate and let's know what your views are? But if you already agree with her, that is your own format too will take that same structure. No need to indicate. Dennis, go ahead.
Okay, thank you so much. For the materiality, I think the maximum is 4 marks.
How did you know?
The cap is capped.
How did you know it's capped?
The examiner answer for the previous sitting.
Okay. The funny thing is, I even said it today. So go ahead. Then is any other thing?
And for the risk,
yeah,
less materiality, the maximum you can get is 2. For the 6 risks she has indicated.
Okay, you believe the mark will be 2 marks each. Is that what you're saying?
Yeah, less materiality. It's materiality that gives that mark.
Okay, so you are saying for you, it would have been 6 risks times 2 marks each, right?
Yes.
Which would be 12. And then for materiality, you would have 4 materiality. Is that what you're saying?
Yes.
Yes. So then what else? How will you then get to 24?
You'll increase the number of marks from the risks. Find more risks.
Find more risks. So tell me, how many risks are you going to present?
So.
I can see you pressing your calculator.
19 plus 4 plus 2. 8 risks minimum.
8 risks, okay.
Yeah,
minimum. So 8 times minimum.
Optimum.
8 times 2 gives 16. And then you will add 4, which is materiality. Okay. Then how do you get to 24?
No, I meant 9 risks.
Okay. Shall you increase it to 9? Okay, no problem. 9 risks times 2, 18. So I go to 24 by fire by force. Very good. Thank you, Dennis. Any other view? No other view. Okay. All right. So I take it that most people agree with one of the 2 of them. All right. So Said, go ahead.
Yeah, I think the only thing that I want to add to it is that talking about the materiality to calculate, the maximum mark to get for the materiality should just remain at 4. So why the risk is to be 6, that is multiplied by 3 mark, which is going to give 18, as the first speaker earlier said, and then the trend analysis should be maximum of 2 mark, calculating for trend, so which is going to give 2. So by summing up everything should give us 24 mark. So the only difference that is there is that the total mark for the materiality.
Okay, so if you are in the exam, you will stick to 6 risks. All right, good. Thanks. Thank you. So let's move on. Here is the marking scheme. Okay, so the examiner says up to 3 marks for each audit risk, unless otherwise indicated. Now, I'm sure we all know what unless otherwise indicated mean. I've told you before that some risks may be 4 marks, while some may be 2 marks, depending on the depth of the risk. But by standard, it will usually be 3 marks. Okay? Marks may be awarded for other relevant audit risks not included in the marking guide. In addition, half mark for relevant trend or calculations which form part of the evaluation of audit risk. Please give up to 3 marks for that. You see that? So you could do up to 6 trend or 4 and then other calculations as you deem fit. So for example, if you multiply that average bonus they paid per employee times number of employees, for example, they can give you half mark for that. Materiality calculation should be awarded 1 mark each, maximum of 4. So you see that? So if I say, now watch this, if I say 6 times 3, that's 18, plus 4, plus 2, that's 24. I think that is a fair estimate. But then, as I normally say, you face the risk that one of these 3 marks may actually be 2 marks. Okay? And given that this is not a question where you are doing analytical procedures, for example, you may want to consider whether I should take this to 7. Okay? Just to be on the safest side. But then, if you think any of the risk is so deep enough that you may get 4 marks on it, so be it. Remember that even some of the 6 risks may have multiple elements in it. So if you already explore the multiple elements, you don't need to write up to 7. Why do we do this at Ivy League? We do it because we know that time is not everyone's friend in the exam hall. In fact, so I'll give you an example. Sometimes when we tutors come to class, we would have said, this question I want to do, 1 hour, 30 minutes, I'll be done. This question I want to do, 2 hours, I'll be done. Most times is a lie. By the time we finish, what we plan 1 hour, 30 minutes for, we end up spending more than 2 hours to do it in class. It's usually as if 1 hour is just blinking your eye and 1 hour is gone. Both in the classroom, now imagine in the exam hall. Well, that is if you know what you are writing. If I don't have something to write in the exam hall, 3 hours is very long enough. Okay, evaluation of Nagan Associates audit strategy and audit procedures. So 1 mark each. I think you guys were on point with that one. And they said if you suggest safeguard, give 1 mark each, subject to a maximum of 3 safeguards. So you see that was what I was telling you guys earlier on this morning, that safeguards may take up to 3 marks. Okay, so that's that. So sometimes safeguards may be limited to 2 marks. Okay, so ideally, if there are threats and you think you want to talk about safeguard, try to give a minimum of 2 or 3. Joint audit, 1 mark each. Then as usual, 1 mark for heading. You see that heading. This heading is like saying to, from, did, subject. Okay, that's the heading they are talking about here. 1 mark for introduction, your introduction paragraph. This briefing note aims to discuss or discusses blah 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 blah, including the advantages and disadvantages of a joint audit. 1 mark for heading within the briefing note is when you say audit risk evaluation. You underline it. Number 1, revenue recognition. You underline it. Revenue, blah, 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 blah. Number 2, provisions. Blah, 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 blah. That is what they give another 1 mark for. Then this last 1 mark is for clarity of comment. This 1 mark is examiner. After you have finished reading what this person wrote down for 50 marks, did you understand what the person was saying, even if it is wrong? Okay, so this is clear. You made it easy for someone to relate with what you are writing. Whether it's right or is wrong is not the point. Okay, so that's what they give that last 1 mark for. So please always ensure you don't leave anything on the table. All right, so let's sort out the audit risk. You told me 6. Let's work with 7. So as usual, let's long list our audit risk. Okay, so what audit risks did you see? It is 1 risk per person. So I'm expecting to see at least 7 or 8 hands. So I'll be waiting.
Copyright infringement.
I'm still only seeing 1 hand. What is happening? 2. Oh, okay. Maybe because I'm the one that read the scenario, I should have given you time to go through it yourself. Okay, no problem. Keep bringing the hands. Keep bringing the hands. I'll be patient. Don't worry. If you are not on mute, please be muted. Okay, so now I have a barrage of hands up. Let's take it 1 by 1. Okay, Arit, you go first. As usual, what I just want you to do is to identify the risk. We are applying the framework we discussed earlier today. Remember, we said you identify background or context. What's the next thing? What can go wrong, which is the risk, and then the impact. Okay, so but for now, just identify. Go ahead.
Okay. Different year-end and accounting standards between different segments and
different year-end and accounting standard. Noted. Next person is Juliet.
Cut-off risk.
Harit, please be getting ready to explain your point. So Juliet says, sorry, cut-off risk. Okay, no problem. Juliet. Please, I don't want stories when we call your name. Once we call your name, just tell us how you would explain it if you were in the exam hall. Bernard, go ahead.
I'm saying 5 years amortization. But they
5 years amortization. Okay, so that's Bernard. Thank you. I'll come back to you. Ikenna, go ahead.
Okay, I'll say non-presentation of Daruko as an operating segment.
That your identification is longer. Should I just say operating segment? Keep it short. Okay, Ikenna more. Okay, more hands can still come. Bisola, go ahead.
Yeah, copyright infringement.
Copyright infringement. Bisola. Motolani, go ahead. Bernard, please mute your mic.
I would say impairment.
Impairment. Okay. Okay, go ahead.
So I'll say component auditor.
Component auditor. Okay. So this is 1, 2, 3, 4, 5, 6, 7. So let me just take one more. Juliet.
Revenue recognition.
Revenue recognition. Julie. Okay. Peace. Go ahead.
Like local accounting rules, local accounting rules.
Okay, local accounting what?
Rules.
Rules. Okay, So then you said Dariel. Okay. So that's peace. Peace of Africa. Ife, go ahead.
I would say target linked to profitability.
Say that again. Target what?
Target linked to profitability.
Oh, target linked. Linked to profitability. Powerful. Profitability. Okay. My experience has shown that it's very easy to create labels. So it's tougher to put them down in writing. So let's start. Please, as I said, we don't have a lot of time. I was able to refuel during the time the second tutor came. But you know, you've been in class all the while. So the faster we are, the more we can close earlier. So Ari, go for it. Remember my framework.
Okay, Shay. Fine. I'm not yet done with materiality for the total assets of Darico, but I'll do what I have. So the group and Darico, is it the group and Darico have different year ends and different accounting policies, standards. IFRS requires that for consolidation purposes, the year end and accounting policies for group members must be uniform. If the subsidiary has a different year end and can't be adjusted, the significant and relevant transactions and activities that happened in the subsidiary in the date not covered should be accounted for. Now, there is a risk that the significant transaction that occurred in dairy for the month of October was not taken into consideration in the consolidation process. Okay, Darico is material. So like I said, I've seen the total assets of Darico as 140 million, but I've not had time to, I'm still trying to check for the total assets so I can compute the materiality of the total assets and the revenue that it contributes.
No problem. Just keep and move on.
Next is, so this is going to affect, there will be, the impact is that the revenue and the total asset will either be understated or overstated. I'm done.
Okay, so pretty much I hear you talk about different accounting years. I didn't hear you say anything about different accounting standards.
Yes, that's for the 3 marks. If I add the different accounting standard, it will be 4 marks.
Okay. All right, so quick correction, quickly. You will not get any mark for what you said, because I'm sure you misinterpreted the question. It says all companies within the group have the same financial year end. And with the exception of Dariel, which reports under local accounting standard, the group companies all use IFRS standard as that. So what they're saying is everybody has the same year end. Also, everybody uses IFRS. However, the exception is Dariel. So there's no different accounting year in the question. And then you didn't talk about this, so we will have to wait on peace. Cut off. Juliet, go ahead.
Okay, so the company's main source of revenue is from subscription charged on a monthly basis, which usually is recognized as revenue at the start of the month. So there is a risk that if a subscription runs into the next year, appropriate cutoff will not be applied on the revenue as required by IFRS. So this would overstate revenue. That's it.
Okay. So you are picking that from the fact that they said the group's business model is to acquire licenses and customers pay monthly subscription fee to access them and watch online. So you are picking from the perspective that since the year ended September, if I paid for my subscription or if anybody pays for their subscription, let's say 15th of September, 20th of September, they are supposed to prorate it. Is that what you're talking about?
Yes, exactly.
Okay. Okay, so you know what? I will pause that point, okay, and I will come back to it after I have heard Juliet talk about revenue recognition. 5-year amortization. Bernard, go ahead.
Okay. From the question, we are told that the finance director is saying he will amortize the intangible asset for 5 years. And from the question, we got that some have a finite life of 3 years, while some 5 years. So the accounting practice that all of them will be amortized over 5 years period is against the IFRS standard. The standard says that every intangible asset that has a finite life should be amortized using that finite number of years. So using a 5 years period for something that has 3 year life, this thing is not in line with the standard. And if you look at it, what will go wrong is that revenue for this period will be understated because the cost will suppress. We push some things over why the asset will be overstated for this period because the number of 5 years that is in. If you look at the figure for the materiality, it's around, you calculate taking that 580 in the question by that 780 is material. When you look at it, it's highly material, about 74% of it. So I think that's what I would say.
Okay, Bernard, nice one. You talked about the fact that they should have amortized these intangibles over their respective life rather than using a blanket 5 years. Then I like the fact that you talked about the impact. Okay, just that you mentioned revenue. I think that was a mistake. You probably meant profit because you're talking about amortization. It won't impact revenue. You did materiality. That is good. I'm happy you did 580 over 780 and you emphasized that that would be significant in material. So good point, good attempt. Ikenna, go ahead.
Well, thank you very much. For Daruko, according to the IFRS, Daruko is an operating segment because it constitutes more than 10% of the total assets of the group. Now, the standard requires disclosure separately on the face of the financial statement, the results of the operating segment, so that users of the financial statement can actually see the impact of the business of Daruko on the group account. So in terms of materiality, it's also very material because it even constitutes almost 20% in terms of the total assets. So in terms of presentation, there's a lapse in presentation and relevant disclosures within the financial statement. Thank you.
Okay. So I've got to be careful with your points. It's a smart one, but we have to be careful. Number one, I agree they have to provide segment disclosures. Number two, I agree that there may be a segment because it is more than 10% of total assets, okay, using IFRS 8 thresholds. However, I would want you to make your points conditional. And what's this condition? First, you don't know how the business is viewed by management. They may not be viewing their business by country or by subsidiary. They may be viewing their business by the services they provide. For example, there may be TV segment, an internet subscription or whatever segment. So they said internet streaming services for film and TV programs. Okay, so they may be viewing their business for film and for TV as their segments. They may have a segmentation that is based on geography, such as Africa, Asia, Middle East, Europe, rather than country by country. So we really don't know. Do you understand? So what I'm just trying to tell you is push your points further to say that depending on how the chief operating decision maker views the business, allocate resources and assess performance, if you know, segments are viewed at the subsidiary level, you know, rather than by service offering, then it will be the case that Daryl should be a segment on its own, you know, reported separately. Okay, so I hope you get the gist that I'm trying to. So just make the point conditional because they really didn't give us details around basis for segmentation. All right.
Thank you.
Yeah. Bisola, go ahead. Quickly, short, sharp, and concise, okay?
Yeah. Copyright infringement. In this scenario, the company has a legal case of streaming a film of which license has not been acquired, and the company has refused to make a provision for it. Then accounting standard states that if a provision is probable, if it is probable, then a provision should be made for it. So there's a risk that the legal claim will be probable and the company does not have sufficient amount, like they don't have provision for it to cover up the claim. And also this might affect the going concern of the company. So the impact on their financial statements, that's the impact of their financial statement. So there's a risk that the financial statement is that the basis of presenting their financial statement is wrong, and also that their provision is understated.
Okay. I don't know why you don't want Baby Bisola to share his or her own views. Anyway, thank you.
Yes, sir.
Yeah, so quick points. That's fine. I think I picked something. I hope I've not forgotten that thing now while you were talking. So yeah, maybe I would rather say you missed out something. You have assumed that it's probable. What if it's a possible obligation? So you are supposed to see it from, you know, different scenarios. Probable, provision. Possible, contingent liability. So the risk is that if not disclosed, you know, the nature and effect of such contingencies. And if it is remote, meaning it's virtually unlikely, then you know, it won't warrant, then the FD or the CEO, whoever the person is, will be correct in that regard. Then I think that maybe you could have used that opportunity to also reflect on, you know, why is the CEO ignoring it? Okay. All right.
Yes.
So, but points noted. Impairment, Motolani, go ahead.
Yes, so goodwill impairments. So in the question, it says that due to the strong performance of the group, impairment of goodwill has not been recognized in the recent years. However, IAS 36, impairment of assets, states that goodwill should be tested for impairment annually. So in the question, there's a risk that goodwill may have been recognized wrongly. The impact of it is that it may have led to the overstatement of assets and profits before tax. The goodwill is 17.31% of the total assets, which is 135 over 780. So it is material to the group's financial statements.
Okay. Powerful. I'm trying to look for something. I thought I saw something about yeah, so we've got this. Okay. Yeah, the group activities. Okay. All right. Does anybody have a different view, or maybe something you would have added to the goodwill statement?
I will just have that it was stated expressly that its goodwill is not impaired in that note 3, saying that goodwill arising on business combination is tested. They said that they test it annually for impairment. Due to the strong performance of the group, no impairment of goodwill has been recognized. So I don't think it's an issue because they test it annually and still there's no impairment.
Yeah. So, okay, go ahead.
Hi, Shay. So, I think impairment of goodwill is an issue. So, if you look at that note on note 3, it says, due to strong performance of the group, no impairment of goodwill has been recognized in recent years. But if you now go to that strategy document, it says internet services in the country have been subject to considerable disruption. And because of this, customers have been canceling their subscription. Because of this impairment that they have recognized on this entity should be assessed for impairment because they are obviously losing revenue. Cost may not go down, but the revenue is going down. Thank you.
Thank you. So, Motolani, now, here is what happened to your attempts. That statement you made, if you had given your point that way, I'm not sure it will earn marks for the reasons stated by the second person. Okay? They already told us that your view was it should be assessed for impairment annually, right? So, and they already told us that they do the assessment. Okay, so, but the issue is the correctness of the assessment that have been done based on the fact that that subsidiary, which is Daryl, which is actually the one giving us that goodwill of $38 million, is expected to make losses in the current year. So that's a strong indicator that that goodwill is impaired. Okay, so if that's the case, then it might be the case that they might have, applied some assumptions, estimates, and all of that may not be appropriate. Or the assessment might show that even though it's expected to be loss-making, there is no loss or impairment loss. So bottom line is just that there's a risk that the impairment assessment is not properly done. In terms of the impact, you're fine. Yeah, in terms of the impact, it's fine. I'm not sure if you did materiality, 38 million divided by total assets. Did you do that?
No, I did 135 million. That's the total goodwill divided by 780.
Okay, so you see, the 135 million is the total goodwill for the group, right? And if, again, we may not, note 3 is not really our guy. Let me put it that way. Our guy is really more of, that note before that page on Daryl, which says Daryl was acquired several years ago and goodwill of this is recognized in the financial statement in respect of the company. So since Daryl is the one making those losses, it may be the case that the goodwill on Daryl is actually the one that may need to be assessed for impairment, okay? But I suspect that even if you are done 135, you will still get your full marks. So that's fine. Okay, go ahead.
Yeah, Shay, so on components and auditor, and basically all the companies in the group are audited by us except Dareco, and which is a foreign subsidiary audited by Nigan Associates. The component auditor may not have the skills, experience, and sufficient independence to carry out the audit to our satisfaction, the audit of the component subsidiary. And there's a risk that we might not be able to rely on the work of the component auditor. And the component subsidiary is basically a significant. This subsidiary is a significant component and contributing 18% of total assets. It is also the only subsidiary that does not use IFRS, that does not follow IFRS. So makes it a higher risk for us to rely on the work of the component auditor.
Okay, thank you. So yeah, okay, so again, I think my feedback will be from the perspective of the fact that if the company is using local GAAP, okay, and these guys are auditing for the sake of local reporting, that's fine, yeah, but that means they may also have to certify the numbers for IFRS, okay. I think you focused more on competence than independence, and I have a feeling. I mean, they've been the auditors of Daryl for some time, right? So I have a feeling that there may really be no problems, big problems around competence, but bigger problems around objectivity and independence because of the non-audit work that they are doing for them. So if there's any improvement need, I would just say don't only focus on competence, experience, but also check, are they independent and are they objective? I hope you get that. Juliet, go ahead.
Aisha, you were going to comment on Arit's points based on what you get from this organizer.
No. It's Juliet's point based on what I get from Juliet. Interesting. Julie. So one Juliet is going to probably help another Juliet. Well, peace. Yes, so go ahead.
Okay, so I'll be talking on revenue recognition. So based on note 1, which says that members are billed in advance of the start of their monthly membership, that the group recognizes the revenue based on the invoicing, which is rather ahead of performance obligation. So in my opinion, there is a risk that revenue would have been recorded rather earlier before it is earned. As a result of this early billing, there may be an overstatement of revenue and hence profit. Thank you.
Okay. All right. So your focus was on the fact that there's advance payments, okay? And what they told us in the question is that they recognize revenue at the point. They say members are billed in advance of the start of their monthly membership, and revenue is recognized when the bill is sent to the customer, all of whom pay by credit card. Okay, so that's your focus, right? We've sent out an invoice, you pay or you don't pay. We've provided the service, we've not provided the service, we recognize revenue. So that's good, that's fine. Now, if we are to reflect on that based on what Juliet then said, Juliet's focus was we may have a situation where some customers may be invoiced in the middle of the month, okay? Now, if the company already recognizes revenue at inception, then the issue of cutoff will really not be the issue, okay? So obviously, I mean, by the time they start doing the right thing, then you may want to think of cutoff risk, right? But I believe that once they fix what Juliet is talking about, then cutoff will automatically be fixed. So are we going to say that the system should be recognizing revenue on a daily basis, or should the system be recognizing revenue at the end of each month? What do you guys think? So obviously there are three options. Does DSTV recognize revenue the moment they charge you for the subscription at the beginning of the month? Do they recognize revenue daily, or do they recognize revenue at the end of each month? What do you think?
Hi, Shane.
Hi.
So, in my opinion, I believe they would recognize it at the end of the month when performance obligation can actually be measured. That, okay, for this particular month, this subscriber has actually enjoyed the service. So we have fulfilled our obligation to give them the service of watching, and we have earned the revenue. Thank you.
Okay, any other view?
I think daily would be preferable because
you think what?
Daily would be fine.
Okay.
Yes, because you're supposed to. What if the person does not pay at the beginning of the month? So at the end of the month, you cannot completely say that you have earned that revenue, except maybe at that particular date that the revenue, the subscription elapsed. So I think daily would be fine for recognition of revenue for such kind of business.
Okay. So let's be a bit careful. If my now, I've got a feeling that what is happening in this scenario is quite similar to, you know, the normal DSTVs and the Netflix and the rest, right? If your subscription ends at the end of a month and you don't pay, right? You can't use it. Please be on mute. Please be on mute. You can't use it. And then if at any time you pay, maybe 12th of the month, then your subscription takes you till the next 12th of next month. So the question really is, when I pay, listen to this. The moment I pay for a month, what is your performance obligation? Is it to provide me with daily access or monthly access? Certainly the answer is monthly access. If something happens to your network and on day 25th, I can't get access again, you certainly have to fix the remaining days. So if an entity has a system that allows you to recognize revenue daily, fine. The more practical one will be at the end of each month. Okay. Now, compare that to telcos or let's say airline. Airlines will recognize revenue the moment they arrive at the location. Telcos will recognize revenue as you make calls. Someone is not on mute, okay? Telcos will recognize revenue as you make calls, you know, not when you load the recharge card or when you buy. So revenue recognition for some entities, banks will recognize revenue daily. Their interest income is accrued daily. So it depends. So it's also possible for this company to be recognizing revenue daily. It's not overly complex. But at the end of the day, the key question will be, the moment I pay you, what is your performance obligation? I believe it is to provide monthly viewing. Okay, so at the end of the month will make sense. Now, if that's the case, the point around Juliet's cutoff risk, which is really where I'm going to, is this still going to be relevant? Okay, the moment I explain what the second Juliet mentioned, then the issue of cutoff may really not be relevant, because any money I collect before year end, before 30th September, I'm not supposed to recognize it as revenue. But if they use daily accrual, then there may be issues around cutoff. So that's why I waited. But to be honest, if I'm in the exam, I really won't push for cutoff, because I don't think it may be a significant risk. Okay. All right. Peace, go ahead.
So this point has been raised by others that I would add. I would structure it like this. The real core is material at around 18%. So this makes it a significant component based on that benchmark. So it's the only company which does not report as under IFRS standards. So in accordance with IFRS 3 business combination, for consolidation purposes, group accounting policies have to be applied to all account balances that form amounts in financial statements. So there is a risk that these policies are not applied correctly, meaning that amounts which have been recognized in respect of the real core are not disclosed appropriately.
Fantastic. Good point. Yeah. Very good. Very good. Very good. Very good. Thank you. Very good. However, the standard you meant is IFRS 10. So that's the one that requires uniform accounting policy on consolidation. But very good generally. Okay. Ife, go ahead.
Okay. So there's a reward scheme that is attached to profitability, and which means that management of the group can misstate their books and increase profitability so that they can partake in this incentive scheme, knowing fully well. And we can see that this scheme is actually very material. They have over 6,000 employees that participate in this scheme, and this scheme is 5% of their salary, of their total salary. Already in prior year, they gave out 1,250 per participant. So if you multiply that by 6,500, you have like 8 million, which is like 1.3% of the total asset, which is material to the financial statement.
Okay, good. Thank you very much. So thanks for the materiality. Yeah, so I like the fact that the incentive for accounting manipulation, but I think what I would have loved to hear in addition is something around examples in the scenario that may demonstrate that they are trying to be overly optimistic around certain things. For example, you can link it to two things, okay? You should actually link it to two things. One, the optimistic accounting estimates by using 5 years when some assets are 3 years related to amortization. Two, the director saying, no, we are not going to make any provision for this. Obviously, it knows that that provision is going to impact on profits, okay? So just link it. And then obviously it's a listed entity. So there will probably be expectations around performance that analysts will be looking forward to. Did you get that? All right. So yeah. So I think I've got points. I've got good points. I have this 1, 2, 3, 4, 5, 6, 7, 8. Good. Fairly good. So let's see what I have here. I'm just going to run through it. A very sharp race. And you can obviously get detailed answers after the class. So what do we have here? So obviously you've got to do this. Very important. You know, you have to put your to, from, subject, date, all those things. Very important. Then your introduction is telling the examiner what your report is about. I know that is 1 mark. I know this is 1 mark. I have to do it. Okay. Next, audit risk evaluation. So you create that as 1 heading. Annual incentive scheme. So you give a background, you know, just like Ife did, you know, the employees are remunerated based on achieving certain targets, and some of those targets are financial, profit related targets, okay? Profit related targets. So because of that, we believe that creates an incentive for accounting buyers, okay? Accounting buyers. So, and that could be revealed based on various accounting estimates. Remember, a provision of disclosure of contingent liabilities and accounting estimates. So the legal case, how they treated that. You are not really focusing on the legal case, you are just using as an example, and then the estimation around useful life of you know, assets, okay? So, and then you talk about the materiality. So I like the computation you did. So you assess the materiality, and obviously an item like this, any area could be affected, any area of the financial statement, typically income and POL, or understatement of liabilities, overstatement of profits. Okay, so that's that one. Please, if I'm saying anything that you don't understand, please indicate. There's someone that wanted to speak. Sheyi Salim, can you go ahead?
All right, thank you, Shay. So I really was just trying to, you know, like feel the weight of one of my responses, because I've attempted it before and I have it in front of me. So I just wanted to read it out to even see if it's worth any mark whatsoever, at least for the goodwill impairment, just to, you know.
Right. Go
Okay,
ahead.
so my very brief response to the, like, more like trying to explain the impairment of goodwill goes thus. So I said it's not clear what model or standard has been used to test the implement of DARICO. Hence, there's a risk of material misstatement in the financial statements. More importantly, there's an indication of impairment as a result of cancellation of subscriptions by customers due to bad internet service. Hence, the 38 million, which is 27% of the total asset of DARICO, is constituting a risk of material misstatement for the group. So, like, I mean, that was it. So I don't know if that's even makes sense.
Yeah, but I'm not sure. Where did you get that 30 something percent?
38 million. That's the.
You said it represents 20 what percent?
27% of total assets.
How did you get that?
Of DARICO.
Oh, of Daryl. Okay. Meaning it's material at the component level, right?
Yes.
Yeah. Okay. Yeah. The most important thing to me is the emphasis on, you know, fall in internet subscription, or whatever they say, loss of customers. Okay. So it's fine if only you can also just link it to the fact that that's an impairment indicator. And
yeah, so that's what I said. So okay. I mean, I mentioned that there's an indication of impairment as a result of cancellation.
Right.
Yeah.
Yeah, so that's fine. So that's fine. Legal case. Yes, so as usual, give a background, just the same way Bisola talked about it. Okay, but as I told her, you should see it from two perspectives. So once you're talking about a provision, that's if probable, okay? And then this is recognized, okay? So the risk related to this one will be related to liability and profits, right? But if possible, if it's a possible obligation, then what should they do? They should disclose. So the risk related to this one will be inadequate disclosures, okay, or incomplete disclosures. And what should they disclose? The nature and the effects. The nature and the financial effects. And obviously you then talk about the impact. I'm not sure if did they mention where's the legal this thing again? Content. Yeah, so if there were materiality, okay, yeah, so legal, I'm not sure they mentioned any values. Yeah, so we may not be able to talk about materiality there. Okay, so next, group finance director. So I don't think anybody reflected on this guy's attitude. Okay, so ignoring the legal case and saying that it will not provide any further information. So that's a limitation on the scope of our work, right? If the group finance director is saying, so look at what he said. The group finance director is not willing to recognize the legal claim within the financial manner as is confident that the claim against the group will not be successful, and he does not want to discuss it further with the audit team, emphasizing that there is no relevant documentation available for evaluation at this time. So that sounds a bit aggressive, right? And so we may need it to bring to the attention of those charged with governance. So that's where the audit committee comes in here. Okay, so and then given that attitude and that mindset and all the changes in estimates that seems to be happening, for example, around amortization of leases, no impairment on intangible assets, no provision for legal case, then this may also mean that we will need to approach the audit with, you know, an attitude of professional skepticism. And yeah, uniform accounting policy, I think this was clearly articulated. What could go wrong is the fact that you could consolidate, you know, the financial statement of Dariel that is not IFRS compliant. Okay, so that's the compliance. Okay, so that's the issue, and obviously the impact of this. So what you will talk about here is the materiality around. I like the fact that Peace told us it's a significant component. Okay, so significant component. So that gives you a mark, you know, for doing that. And then obviously these are, you know, when we say misstatement may be isolated, misstatement may be, you know, wide, broad, and all of that. So this is an example of an area where the misstatement, if it is not IFRS compliant, is unlikely to be isolated. Again, remember the point. For local reporting purposes, they can use any standard they want. But for consolidation purposes, they have to convert their local financial statement to IFRS account before it is consolidated. Impairment. So obviously, yes, we've talked about this. You give the background, the fact that the company is expecting losses, and losing subscription or losing customers. Okay, so you talk about that from an impairment indicator perspective. Okay, so and obviously the risk is that goodwill impairment assessment was not properly performed. For example, there's a risk that they might have used unreasonable assumptions around cash flow projections or growth rates, e.g. growth rates in cash flows. Okay, so management may also not have experience regarding this. Did you see that the 135 they started with is still the same 135 we have? It did not change. And we don't know whether they've ever done any impairment tests. So, that may, reflect on the fact that possibly they might not have done the right thing. Okay, and obviously the impact will be that profit is overstated. And again, as I've said, you can reflect on the incentive they have to not recognize an impairment loss. Okay, component auditor. Yes, so someone already explained this vividly. And as I said, not just the competence, but also the independence, particularly arising from provision of an accounting service or bookkeeping service, accounting and bookkeeping service, Remember that this company is a listed entity. So question really is, should you do that? I guess there's another part of the question that allows us to reflect on that. So again, significant components, as someone has already emphasized. Post-year-end acquisition. I think this is the one that everyone missed out. I didn't hear anybody talking about IAS 10 required disclosures as regards, what's the name? The planned acquisition. So IAS 10 says that's a non-adjusting event. Is that not true? So the risk is that they might not have disclosed the nature, the financial effects, when it is likely to be fully consummated, such that users are aware of that. Okay, so and obviously the impact will be the issue of incomplete disclosures, as usual. All right, I think, okay, a few more things. So we've got here, sorry, just one moment. Trying to. Okay. So license. Obviously, Bernard also gave us the point there that you should amortize intangible assets over its useful life, usually on a straight line basis with 0 or nil residual value. So the key issue here is they told us that these intangibles have 3 to 5 year life, but this man has decided to use 5 years, and that will result in lower amortization charge. Okay, amortization charge. So, and obviously increasing their profit. So we may also want to find out, did they change this policy to 5 years recently? If that's the case, what's the basis for that? That would be very important. Revenue. So revenue, as Juliet said, premature recognition of revenue is really the risk here, which is the fact that there's a risk that they are recognizing revenue before performance obligation is fulfilled. Okay, performance obligation is fulfilled. So that will mean that they are overstating their revenue. Okay, and understating their liabilities. That will be the impact in that area. Now, I wanted to touch on the issues around trend. So let's see whether we can make sense of certain things. What's the percentage increase in revenue? Can someone help me with that number? Percentage increase in revenue.
$25.6.
25.6% increase in revenue. Okay, so that's a very huge increase that the group is expecting. Now, that may probably be due to the increase in subscriber base. So what's the percentage increase in number of subscription customers?
%30.
30%. So could there be a reason for this huge 30% increase in number of subscribers? Okay, perhaps that could be due to some incentives that they've started. They said the group also introduced a new premium subscription package, which allows customers to add family members to their subscription for an additional fee of this. So this additional fee might have increased their revenue. People may like that scheme, and that might have resulted in this increase. But given this volume, what's the ability of our systems to cope with this increased demand for our services and the fact that we are capturing revenue accurately? So typically, auditors are a bit skeptical and will want to probe further once you have such huge increase in your revenue, particularly when the level of activity has increased, just to be sure that it's not the case that certain amounts that should not have been recognized as revenue have been recognized. For example, if you are adding 2 family members, you are only to pay $5 per month. What's the risk that the system might have been doing, 5 times 2, which will be $10, as if they are 2 different individuals. You may also calculate, revenue per customer, per month, revenue per customer per month. So for example, if I divide, what's the name, 980 million by 12, what will that give me? 980 million by 12, what would that give me?
$81.7.
$81.7 million per month. Okay. Now, if they have 10.5 million subscribers, can you divide that by 10.5? What does it give you?
7.8.
7.8. Okay. So if revenue per customer per month is 7.8, but our standard price is 8.2, and we also added $5, when you bring in 2 additional people, then something may not be adding up here. Just simple analytical procedures, if you get what I mean. Okay, so the audit team may also want to look at that to see whether those revenue numbers are actually accurate and there are no problems with the systems that is capturing revenue. All right. Okay, so let's move to the next part of the question, evaluating the audit strategy document. So what did they say? They said evaluate the extract from the component auditor's strategy, commenting on the audit strategy responses and ethical matters relating to the issues identified. So tell me, what will be your point? Obviously, there are 3 issues here, so obviously you have to address the 3. If you have a response, let's take it one by one. So let's start with materiality. I'll give you time to think, and once you have a response, just indicate by raising your hand.
Good evening. Yeah.
Good evening. Okay, that was a mistake. So please reflect on materiality. What will be your points in that area? I believe we should wrap up in the next 20 minutes thereabouts.
Oh.
Still waiting. All those powerful people in my class, where are they?
Okay, I think that when we're considering materiality, we need to first of all look at the impact, like what aspect of the financial statements will it be impacting more upon. So yeah, it says the auditors, they've been basing their materiality on revenue prior to this year, and because revenue is decreasing and they're projecting to make a loss, they're going to shift it to assets. So this poses a question: why are they shifting it to assets? Because obviously revenue is decreasing, and then we also need to look at, okay, what aspect of the financial statement is it going to be impacting? So if it's going to be impacting the statement of profit or loss, it makes sense that we use revenue as our benchmark. But if it's going to be impacting more on the statement of financial position, then we could use asset as our benchmark. But I think their assumption that they're going to be using only asset as a basis for their materiality is wrong in this case.
Sorry, when you say which one is it going to be impacting more, if it's P or L, it makes sense to do this. If it's this, when you say impact, what is impacting? What's creating the impact?
I mean, whatever it is that they are benchmarking against the materiality. So, for example, if we're looking at, let's say,
I see what you mean. I get what you mean. Okay,
yeah.
I get what you mean. I get what you mean. So you're all right. Okay. I would explain something to you. So what they said here is materiality will be based on total assets for the first time this year due to the strict significant reduction in revenue and profit. Materiality of this in the previous year, materiality is based on this. Okay. Yeah. Okay, looks like there's no other point. All right. Now let me talk about this area. Okay, based on the points that I have. Number one, you will tell the examiner that materiality is based on judgment, and there are a lot of factors that will help. There are a lot of factors within certain materiality that would involve the use of judgment. For example, what benchmark to use, okay? What benchmark to use, okay? However, everybody take note of this. The benchmark, first of all, auditors set materiality at 2 levels. Minimum financial statement level, which is sometimes called the overall materiality, okay? Overall materiality. And then they set another one for at the account balance and transaction level, okay? Which is sometimes called account balance level materiality. Okay, so different firms call it different names. Some call it planning materiality, okay, PM. Some call it performance materiality. I really don't want to go into names that it's being called. Now, the materiality we use for the exam is often this overall materiality, which is the financial statement level materiality. Okay, now I get the person that spoke. Unfortunately, I didn't see the name. The person that spoke was probably reflecting on the fact that, okay, why is this an issue? Why must you say it's total asset? After all, we do some against PBT, we do some against total asset, we do some against revenue. So why against total assets? Why restrict? Now, hear this. Those materiality levels that you compute for balance sheet, for P&L, for revenue, and all of that, there's still a need to calculate overall materiality, okay? Which is this first materiality that I'm talking about. That overall materiality is what the examiner is talking about here when they said they have decided that the materiality will be based on assets, okay? So the question you may now have is, Shay, I hear you clearly. You've talked about 1 to 2% for total assets. You've talked about 5% to 10% for PBT. You've talked about 0.5 to 1% for revenue as my materiality at the account balance level and all of that. How do I then get my overall material? Which one of these will be my overall materiality for